Many people exploring franchise ownership treat funding like a finish line. Find the business, negotiate the deal, then go find the money. But by the time they have the first conversation with a lender, some of the most consequential decisions about their retirement accounts, their credit picture, and what they can actually qualify for are already locked in. In this episode, franchise funding specialist Michele Simones explains why the funding strategy has to start early in the franchise search and not near the end. Welcome to Ownership Essentials. I'm Scott Elliott, and today I'm joined by Michele Simones. Michele is a franchise funding specialist with Guidant Financial. Now, Michelle's background spans financial consulting, sales leadership, and business ownership. So she brings a lot more than just a lender's perspective to the franchise funding conversations. At Guidant Financial, she helps aspiring owners to navigate their various financial options, including strategies that let you tap retirement funds without any penalties, as well as traditional debt financing, things like SBA loans. Michele, welcome to the show today.
Well, thank you very much, Scott. It's a pleasure to be here.
Fantastic. Well, I hope we have a great conversation because we're talking about something that's on the minds of many aspiring owners, and that's how to navigate funding. And specifically, we want to talk about when in the process we should be putting financing, into our minds, right? There's a lot of people who treat this financing as like a final step before they sign. They're like, okay, I know what business I want. I know the area. Now let me go find money. But you work with candidates all the time who approach this very differently. So maybe could you explain to us a little bit what is a funding strategy and why is it different than just, picking a bank to work with?
Yeah, absolutely. Great question, by the way. Most people think financing is simple. They'll just apply for an SBA loan or I'll talk to my bank. But in practice, lenders don't fund based on preference. They fund based on the applicant's overall financial profile, their liquidity, income, credit, and including the business itself. So a
Mm,
true funding strategy looks at all the available options together, such as SBA financing through a lender, term loans for smaller capital needs, ROBs, where you can use your retirement funds potentially to invest in the business with no tax implications, and
mm,
personal cash, HELOCs, or even investor contributions. And oftentimes, many times, it's going to be a hybrid of those. So the goal is to match the right mix of capital to the candidate's actual situation and not fit them into a single product. It differs
mhm.
from just picking a bank because banks don't compete to fit the borrower's needs. The borrower has to fit into the bank's criteria. So a funding strategy flips that and asks what is the strongest path to approval? What structures are going to minimize and preserves liquidity? What combination of funding sources best supports the business at launch and during ramp up as well? Everybody focuses on the beginning of the business and the startup, but you need to make sure you have a long enough runway as well. And then what will
Mhm.
actually get this deal closed?
Okay. No, there's a lot that goes into that, isn't there, Michelle? There's a lot of factors. And I like what you said there about flipping the script. It's not you fitting into the bank's criteria. It's how can the funding strategy support the business you're trying to launch? So that's good. Um, at what point in this exploration process, so somebody's looking at various franchises, they haven't yet decided which one they want to go with. At what point in that process should they have a conversation with you? And what happens if they come to you too late?
Well, Scott, that is a perfect question, and you're absolutely right. They should be looking to have a funding conversation prior to the franchise actually being selected. It's very similar to going to buy a property or a house. You're not going to look at properties and then go to the bank to get the pre approval letter. You want to
Mhm,
get the pre approval letter first and then find out what you can afford so you know that you're making the right decisions as far as what time to spend on properties. Same thing with the franchise. You want to make sure that you have a funding plan in place that's going to support your own personal financial situation before, again, trying to flip it and you find a business and trying to fit that into your personal financial situation. Sometimes it doesn't work. And I often have conversations with people, and they actually, a couple this week, wanted to afford a multi-million dollar franchise. And after talking them down, or acquisition rather, that was not a good fit for them. They really
Mhm.
needed to start in the startup phase where it would be costing them just a few 100,000 instead of a couple million, and that came to a big surprise to them. So you never know what you're gonna be able to, qualify for or get approved for, so it's always good to start sooner rather than later.
Yeah, no, it's a great point because it's hard when you do a lot of planning and then realize that your plans are getting the rug pulled out from under them because you can't even afford what you were trying to do, right? So I agree. I recommend to my clients immediately within our first couple of calls, if they haven't thought through a funding strategy already, I try to introduce them to a partner like you right out of the gate, even as we're in parallel while we're looking at other concepts for them. So that's good. Now, you mentioned surprises, a couple that was surprised. Let's talk about surprises for a minute. When you sit down with a candidate for the first time, what do you learn about them? What are some maybe questions you ask that people are surprised to be asked in this conversation, these initial calls?
Yeah, absolutely. So it's not just about their credit scores or their liquidity.
Mhm.
I'm trying to really understand the real story behind the numbers, and that's often what people are surprised about. For example, we just had a candidate that was being put through the underwriting process with the SBA, and the SBA was asking them for their time commitment and not anything to do with their financing. They had already had all of that information, but they wanted to make sure that the business owner could do their full-time job at the same time and run the business on the side and make it work
Interesting.
and be sustainable. So it's really the whole picture, and it's not just about the finances. The banks really want to see that you're set up for success. And so they're going to look at every little detail. And that's probably why it might take 60 to 90 days to get approved for an SBA loan. And there are quicker options as well if need be. But
Mhm.
yeah, I'd say that's probably one of the most, surprising things to people is it's not just finances, it's the time commitment as well. Can you really sustain this to get it up and running for, the first several months?
That that's interesting. I don't know that I knew that was one of the things that came up in the conversation with their funding specialist. So that's great to know. That's certainly a question I asked them, but to know that the banks, the lenders are interested in that too, really goes to show the importance of having this really well thought through and having a partner like you to guide them through those questions. That's great. Now you've mentioned a few different instruments we've talked about, or you mentioned SBA loans potentially, the retirement asset things like ROBS, the rollover for business startups, other types of loans. Walk us through some of those in a little bit of detail. You don't have to go in depth, but where do each of the different instruments, the most common instruments in a strategy, fit? What are they good for, and what are the limits? Just at a high level.
Yeah, that is a great question. And you're right. I will try not to spend so much time on this question because I could take up the entire time just on this question alone.
Sure,
Um,
sure.
but I think the most important one is to realize that the goal isn't to pick just one, it's to match the right capital hybrid strategy to the deal and to the individual. So, for example, SBA loans. SBA loans work great for projects that are going to be a total investment of $200,000 or more. They do require some liquidity. So, oftentimes, people are going to need to come up with 20% or so of the particular investment themselves. So, it's not
Okay.
100% financing.
Mhm.
So that's something to know about the SBA, and their time frame, like I had mentioned before, is 60 to 90 days. So you want to make sure that you plan for that runway. You do need to have strong credit, and it can be personally guaranteed. Sometimes is required, and sometimes they have strict underwriting. So the SBA, while most people go to that as their first choice for a business because that is what's mostly what people understand and have heard of, it's not necessarily always the best choice.
Okay.
Um,
Interesting.
one of the alternatives to SBA lending and that we've been having a lot of good luck with lately are term loans. They are built for smaller capital needs, so who don't fully fit the SBA requirements potentially of larger projects. The SBA's average loan size is 574,000. So when you get
Mm.
down to smaller loans, sometimes they're just not as interested because it takes them a lot of time and they aren't making as much money, right? So at
Hmm.
the end of the day, the lenders are in it for profit. So, term loans have been a fantastic alternative that we've been using a lot lately. They're faster approval, they're less documentation, they're unsecured, so they have no personal guarantee. They are shorter terms. Sometimes they can have higher interest rates, but depending upon your credit score, that may not be the case. We've seen actually lower interest rates compared to the SBA.
Oh,
And
interesting. Okay.
yeah, and they have less forgiving underwriting as well.
Hmm.
So, and then another option, of course, is the ROBS program, rollover for business startups. And that's using retirement funds, if they're eligible, to invest in your own business without early withdrawal penalties or any tax implications. And why a lot of people like this strategy is because it is not financing. So there's no interest or monthly payment to go back to a lender. And outside of cash, it's the cheapest cost of capital. So if somebody is interest sensitive or cost sensitive when they're starting up their business, this is a great complement to potentially another strategy of cash, or oftentimes people use ROBS in its entirety to fund a business.
Hmm.
Um,
Okay.
so yeah, and then of course there's HELOCs. They could potentially use their own equity in their home. That tends to be the cheapest cost of financing if they're going to go that route for financing. And it's fairly quick as well, and it is secured by your personal residence. But if somebody doesn't mind that, that could be a great choice as well. And then of course there's always cash and your own personal liquid injection.
Okay. Yeah. So no, that was a great summary, and thank you. Your timing was very appropriate. Right. You didn't go too deep on any of it. We think about some of the when I've presented these options to my clients in the past, they always have questions about the fit and the risk, right? So HELOC, as you mentioned, you are putting your home as security for the loan. Term loans, though, it's you're not putting your any collateral at risk. Is that correct? Typically,
Correct.
okay,
No,
okay.
it's completely
What about
unsecured.
SBA loans? Are they unsecured as well, or are they? Could you be risking your home if you do an SBA loan or not?
So that is something that people oftentimes don't realize. If you have a
Mhm.
loan size above 350,000, it's one of the regulations of the SBA to actually lien a home. So
Okay.
they would have to put their home up for collateral.
Mhm.
Any loan size under 350,000, it's always up to the lender's discretion. So they may or may not require it.
Okay. Okay. Interesting. And when we think about options for non-U.S. citizens, are SBA loans even available? Like if you're a green card holder, maybe, but not a U.S. citizen, what does that look like? I know that's a little spur of the moment question, but I'm just curious. How that. You know.
No, all good. The SBA has been going through a lot of changes this year, and
Mhm.
some of the regulation has been in March, actually, that they have to be U.S. citizens in order to secure an SBA loan.
Okay.
In fact, everybody that is going to be on the loan needs to be a U.S. citizen.
Okay, interesting. So
Yeah.
in that case, the term loans or a ROBS structure might be more appropriate for someone who is not a U.S. citizen, or is that not true? Are there caveats to that as well?
So as long as they have a green card and they have
Hmm.
available retirement funds, ROBS is
Hmm.
only as good as the amount of eligible retirement funds. So they
Sure.
do have to have built up some sort of American retirement funds.
Hmm.
So that could work if they have those eligible. And then
Hmm.
the other option with the term loans is, again, if they're a green card holder and they have credit history, then yes, they are able to secure funding. However, outside of having a green card, it does get a little bit more challenging for non citizens or non green cards to secure financing. So that's where cash would come into play, investors would come into play for them.
Hmm.
Um, it just doesn't tend to work out as best.
Sure. Sure. No, thanks for that. That was a good snapshot of what some of those key elements are. And do you often see the funding strategy to be a blend of several? I mean, usually there's cash and something, but is it usually cash and a term loan and an SBA loan, or cash and ROBS and another loan, or they usually it's cash and one other thing? Like, what do you often see the structure?
So that's a very difficult question to answer because it just varies
Yeah.
based on everybody's individual situation as
Hmm.
well as their preference. So I do get asked this question a lot actually from my candidates.
Hmm.
But again, I don't think there's one strategy or one blend that is more prominent than another. It just
Okay.
really depends upon what you have available. You know, if you have Rob's eligible funds, if you have the credit and the liquidity for the SBA, if you have the credit and income for term loans. So people can, their situation does often dictate what they can create for a blend. The other thing about the SBA is the SBA typically doesn't like you to combine their strategy with any other lending. Every
Oh, okay.
once in a while, they'll
Interesting.
let you combine it with a home equity line of credit. But
Hmm.
from the SBA standpoint, you're increasing your debt to income ratio. So they don't like that. So that doesn't make you as good of a candidate anymore. And then the other thing is if they are requiring collateral, you're taking part of their collateral away. So the
Mm.
SBA pretty much is just going to be cash and or ROBS.
Hmm.
Whereas if you're not doing the SBA, then that opens up to any other combination. You could do ROBS, a HELOC, a term loan,
Hmm.
however you need cash to put the deal together.
Put the deal together. No, thanks for that, Michelle. That's a great overview. So let's fast forward. Once the deal closes, right? They got their funding, they have their franchise, they're opening things up, but the effects of that funding decision don't disappear, right? I mean, these have long term effects. So talk a little bit. How does the capital structure that a candidate chooses, before day one, how does that show up in their day to day operations and even in year two? Like how does this decision affect their long term operations?
Yes, I really like that question because so many people are just concerned about securing the financing and then
Mm.
everything will be all right. But your financing strategy is going to stick with you, like you said, over the first year and 2 years. So, oftentimes, when we're going through the different options in a strategy with somebody, we do have a cost of capital calculator that we can use with them and we're going to show them what they are wanting to do, what they've picked as their funding strategy, and exactly how much is that going to cost. So they know and can expect that they're going to need to make additional profit to pay for that financing essentially. So
Mhm.
it does have an early impact on profitability decisions. You know, if you take a loan as your primary source, you're going to have to make additional profit before you can actually become in the black because that's an automatic expense there.
Mhm.
So you do need to take that into consideration. Do you think you can make those extra sales over the next first 2 years and that extra revenue to cover the cost of the loan? Or are you more of like an absentee part-time person where you can cover them on your income and you're keeping your job and you're doing the business more as an absentee side business? So it does really matter and it matters how long you can marketing efforts, operational testing without immediate financial strain. So there's definitely some things to take into consideration. And owner behavior takes a lot into consideration too. Too
Hmm.
much debt can lead to more conservative decisions and cost cutting, slower hiring, and tighter reinvestment. That ultimately adds to more stress for the business owner, and that can affect their decisions. Likewise, where if they are not quite as debt heavy, that can allow for more long term thinking and operational investment initially.
Mhm. No, all good points. So there's a lot to think about. I mean, not that people want to be paralyzed, analysis paralysis on how to
Yep.
get the funding in place, but really, I mean, it's good to talk this through and to think about those long term implications while putting the funding strategy together. So, and where it's a great point you make. Things like ROBS, where you roll over money from a retirement asset invested in your own business. Now there's no debt service associated with that. There's no interest repayment at all. It's just a pure investment in the business that on mathematically, it's a shorter time to profitability than if there's interest payments to an SBA loan, right? So very, very interesting. Yeah, good. Thank you for that. Let's talk about common mistakes. What are some of the most common mistakes that aspiring entrepreneurs make when they're developing their funding strategy? What would you say
Yes.
those might be?
So I think probably what I hear the most is, "Oh, I'm not worried about getting funding. I know I qualify."
Okay. Yeah. Yeah.
And so if somebody has a fairly good financial situation, um, they might think that they qualify for funding. And so they wait too long to have those in depth conversations. For example, I had a conversation with a lady today and she thought she was well qualified. She made a good, strong income. However, she had just started her consulting income and she was wanting to have another business to complement her consulting firm. And she had quit her job about a year ago. So when you're going after funding and you're self-employed, the banks really like that business to be seasoned for at least 2 to 3 years. So she realized that she wasn't as qualified as she thought she was because she needed to
Sure.
either have more time in business so the bank could really take a look at what her income flows were, fluctuations, what her expenses were going to be so they could make a good sound of judgment on their end. And then
Mhm.
also, she didn't think she was going to have her husband be on the loan application. However, he did qualify. So that was new to her that she had to bring him in. So people don't necessarily think about the entire picture and what could be potentially going on. So it's always better to have that conversation earlier than later and not treat funding as an afterthought.
Yeah, yeah. No, that's a great point. A lot of mistakes can be caught early and they don't have an impact if they get the advice early enough, right? So you may come in with preconceived notions or misconceptions, but having that dialogue, going through a process, having the voice of experience from a funding partner can really help them cover over those mistakes pretty quickly and recover. So that's great. Thank you.
Definitely, for sure.
So, in closing, Michelle, if someone is 6 months away from seriously pursuing franchise ownership, what's the one thing you'd want them to do or understand about their funding strategy before any other conversations happen?
I think just really getting clarity. It's not necessarily what they think they can afford. It's knowing what they can afford and having the funding strategy in place. I do
Mm,
oftentimes talk to people and they want to prolong additional conversations. Again, going back to another helpful bit of knowledge is with retirement funds, we'll often see people leave their job. They might have Roth 401k funds, and then they roll it over into a Roth IRA thinking that they're consolidating and doing the right thing. But then Roth IRAs are not eligible for ROBs anymore.
okay.
So again, there's a lot of nuances, and I know it's confusing.
Mhm.
Roth 401ks are eligible, but not Roth IRAs. But those are details that individuals just aren't going to know. So just really getting their entire picture so they can prep over the next 6 months and make sure they're making the right decisions to keep themselves in a good position to secure funding or whatever strategy they want to pursue.
Very good, Michelle. Michelle, thank you so much. This was genuinely useful. I really appreciate your insights here. Funding is where a lot of franchise pursuits stall, right? And you gave people a clear picture of what their options look like. So, thanks for spending time with me today.
Well, it was my pleasure. I really enjoyed it. And thank you for having me. And yeah, thank you.
What Michelle laid out today is really a reframe. A lot of people come to a funding conversation looking for approval, but what she actually is helping people to do is to build a strategy first so that every downstream decision, which franchise to pursue, what investment level makes sense, what timing is realistic, all of it rests on a foundation that fits their actual situation. If you're anywhere in the range of 6 months out from a serious ownership decision, this is a crucial conversation. My name is Scott Elliott. I work with people who are exploring business ownership through franchising and want a knowledgeable guide through the process. If that's you, I'd love to connect. Thank you for joining me on Ownership Essentials.